those flashing green lights and I saw the money just going up and up and up and up, and it's a bit like a game really, and it genuinely is. Hello everybody and welcome back to my channel. If you have not subscribed yet, I think that you definitely should, and you can do so down below. It just means that you will get the next videos that I publish in your YouTube feed for you to enjoy. Now, the topic of this video has been a highly requested one, and that is the mistakes that I have made so far in investing in stocks and shares, and pretty much how you can avoid them. So I'll outline the mistakes and then I'll outline the lessons I've learned and how you can benefit from the trial and errors that I have made to not fall down the same pitholes and pitfalls as I did. So the first one is investing too much of my savings. When I was using Nutmeg, the stocks and shares ISA, I didn't really make this mistake. So I had half of my savings in the ISA and the other half in my savings account, and it was always there if I ever needed to dip into it or had any personal emergencies. I always had that security blanket. But when I moved my money over to eToro and the kind of onus was put on me to invest it, I got maybe a little bit trigger happy. So I initially moved the money from Nutmeg straightly onto the new trading platform, invested all of that, wanted to invest some more, so put some more money in and some more money in until all my savings were tied up in different trades. And if any of you remembers or was listening to the financial news back in kind of March to May this year, this is when the crypto market crashed and all of my monies went into the red, which isn't a massive drama. Stocks are volatile. I knew that going in. That's something that I prepare myself for. I wasn't quite prepared for them to stay in the red for 4 or 5 months. I'm also currently trying to build a company, and I have been trying to build it and building it slowly since kind of March to May last year. The massive mistake that I made, and the thing that I'll never do again, is the money that I had set aside to build that company, I invested it into the stocks and shares. And when I wanted to take it out, it was not readily available for me. It was tied up in trades, and because the market had crashed, I didn't want to close on those trades and realize those losses. I wanted to wait for the market to recover. Now, luckily for me, the market recovered slowly and I was able to extract some of those funds in time for payments that I needed to make to grow my business and develop the company. But it definitely took its toll on me. It was quite a stressful period. I definitely lost some sleep over it. There was a moment where I was unsure if I even wanted to continue growing the business, but I kind of sat myself down. I knew that I would really regret it if I wasn't true to myself, didn't believe in myself, and kind of take the leap of faith in growing the business. So it meant that I just had to live a lot more frugally than I normally would over this summer. Didn't get to go and have as many experiences maybe that I wanted to. I like to live in the here and now, and I didn't get to do that as much as I wanted, but that was something that I was willing to sacrifice in the short term to make up for the mistakes that I had made in the stock market and putting too much money in. So the lesson is to only invest and play around with your fund money. So your fund money is money that you don't have to live off, and money that you don't think that you're going to need for any significant life changes over the next 2 to 3 years. So say you have been saving a deposit to buy a house in 6 months to a year, probably not the best idea to put that in volatile trades at the moment, because when it gets around to you wanting to purchase that house or put the deposit down, that money might not be the same amount that you put in initially. The stock market is volatile in nature. It goes up and down, and this fluctuation is completely natural in the stock market. A success in the stock market doesn't quite look like stock starts at A and gradually rises to B. It's more A, B, C, D, E, F, Y, Z, and then might land a little bit higher, and that might be when you decide to close the trade. So it's a bit of a roller coaster, and it doesn't just rise on one trajectory slowly and surely. I wouldn't let this put you off though, and if you haven't seen it yet, the last video that I put out was the 4 easiest ways for beginners to start investing, and in that video I outline the easiest and most secure ways that you might be interested in if you have some money that you're not going to need over the next couple of years, to put that into some stocks, investing in an index, for example. I would go and check out that video. I'll link it in the description below. Mistake number 2, and that is gambling and short-term trading are pretty much the same thing if you don't really have a clue what you're doing. If you're experienced, you could be a great day trader, but I don't have that experience. But I'm very impatient by nature, and I know that. And I know that I've got quite an addictive personality, and I should have been more prepared for this. When I was a kid, there was an amusement park just down the beach from where my grandparents lived. And I was legit addicted to this place. Like the kiddie slot machines, I was on them. I spent loads of time down there. I used all my pocket money down there. I never knew when to quit. It's like all the red flags. So in my adult life, I've been really conscious of kind of my addictive personality, not getting involved in it. In like casinos, when I've been drinking, I wouldn't really go into one. However, the stocks and shares kind of blindsided me a little bit. I saw on the first few trades, I saw those flashing green lights, and I saw the money just going up and up and up and up. And it's a bit like a game, really, and it genuinely is if you're not prepared for it. And yeah, I got a little bit carried away. The instant gratification of seeing, kind of making a trade and seeing the money go up, it basically made me feel like I was just getting free money. And it's great when it's going up, but it can equally and just as easily go down and into the red and disappear sometimes. And I made that mistake maybe once or twice. So I saw there was an index and it was quite volatile, and I wanted to take advantage of that. I was watching it until it went all the way down to the bottom. I made a leveraged trade at 20x, which essentially means on the money that I've invested, I will get either times 20 profits or times 20 losses on that money, which is quite a risky thing to do, but there's the option for on the trading platforms. So that's what I decided. It turned out it was not at the bottom, and it kept going down. And when you make a leveraged trade, there's a stop loss on it automatically. That essentially means when it goes past 50%, the trade will automatically close. And that happened. I got 50% loss, and I lost half of my money on that trade. And I learned now, through trial and error, not to do that again. So here we are. So the lesson to be learned here is invest for the long term. If you want to do short-term trading, it is basically gambling. And if you want to invest, try and choose stocks and indices that have a good track record. Maybe look at it this way: I would prefer to bet my money that Tesla was going to go up within the year, then bet my money that Tesla is going to go up tomorrow. And that is maybe a way of seeing the difference between day and long-term trading. We've already kind of talked about the volatile nature of the market. It's a much better strategy to kind of look at your investments in a 1 to 5 to 10 year basis rather than immediately in the here and now and trying to kind of earn a quick buck, because sometimes it'll work out in your favor, and as it's been for me, sometimes it just doesn't. As you've seen, it's very difficult to try and time the market, and even the best day traders and most experienced out there require a lot of luck and experience to find the exact right moment. There's a different strategy that you can use than trying to invest a lump sum all at one point, and that's called dollar cost averaging. And what this is an alternative to investing one lump sum into a stock or in indices or into any commodity. Let's say that you have £500 or dollars that you have set aside to invest in Bitcoin. Why not? But you know that Bitcoin is quite volatile, all over the place. Sometimes it goes up, sometimes it goes down. What you're going to do is you're going to split that £500 down into £50 segments. Instead of trying to pick the one moment where it's best to invest in Bitcoin and put off investing, you can use dollar cost averaging to invest £50 for 10 months consistently and let that average out. So sometimes you might get it at a really low price, sometimes it might be a bit higher, but you're ignoring the market, you're ignoring the fluctuation, and you're just staying to your pattern of taking the £50 each month and investing it. And then obviously you've got an average price that you've invested over the 10 months. So on to my third mistake, and that is the mindset that all stocks that are in the red, all stocks that have fallen are on sale. And they've got this kind of term in the investing world, and they encourage you to be brave when others are fearful and invest and take advantage of the dips, etc. And again, this is sort of trying to time the market, and it can be quite a dodgy game, especially if you think that you need to do it in a rush. So here's a stock that I thought was a good buy at the time. I saw it drop down loads in one day, and I was like, oh, I know this company. I had a pretty good idea of why I thought that they'd fallen, just because of coronavirus and they haven't recovered yet, and I was pretty sure that they would recover at the end of the pandemic and that it would go up again, and I thought I was making a great trade. I wasn't 100% sure, and it did alarm me slightly how much the stock had fallen, so I only invested £50, but if I had done more research, I probably wouldn't have invested in this company, because there had been other things going on that were available on the internet behind the background, and essentially now the company will either recover and I'll make quite a good return on that £50, or it'll go bankrupt and I'll see none of it again. So the lesson is to do your research and know where you're putting your money. If the stock is down, do your research to find out why. Reasons stocks and shares can go up and down can be something as trivial as a footballer moving a product out of a camera frame, or as big as the company actually suffering and potentially going bankrupt. Not all falls in the stock market are a sale, and some of them you'll be able to take advantage of, like most of the stocks obviously went down in the pandemic, but some of those won't recover, so place your bets wisely, essentially. So those are 3 mistakes that I made, and hopefully those of you watching can use this to avoid making those same mistakes. I know my personality type. I'm definitely someone who learns through trial and error. I don't at any point regret getting involved in the stock market. I've actually had a really good time. I've learnt loads about the economy, about the stock market itself, about investing through the last couple of months. And yes, it's been a bit of a roller coaster. There are things that I would do differently, but every day is a school day. If you enjoyed that, give me a big old thumbs up. It does help this video reach many other people out in the YouTube verse. If you want to have more of my content show up in your page, give us a little subscribe there. It helps me grow and lets me know that I'm going along the right track here, because I'm literally just talking to a camera. If you missed it, this is definitely the video you need to watch next. I'll outline a couple of ways that I learned how to get started in investing in stocks and shares, and how you can too.